So last week, base rate was cut to 4%, and you would think that that is great news for mortgages, right? Well, not quite. And if you're expecting a flood of cheaper rates, well, you might just be in for a little surprise. In this week's news, we've got updates from Santander, West Brom, Halifax, and Nationwide, all boosting how much you can borrow. A flurry of rate cuts and a few increases, and why, despite the Bank of England cutting rates, mortgage costs might actually rise. Stick around because I'll explain what's really driving mortgage rates right now and what it means for you. So let's start with the rate movements. Skipton Building Society have been busy tweaking rates, some up and some down in their residential range, but it's all cuts on their buy-to-let deals. Co-op have dropped some rates, and Accord, well, they've also got a mixed bag, both increasing and decreasing residential and buy-to-let rates. BM Solutions have cut up to 0.31% of their limited company buy-to-let deals. Barclays have made some reductions, mainly on their higher loan-to-value products. And Leeds Building Society have cut selected residential rates for both new and existing customers. Meanwhile, over at the Mortgage Works, some of their limited company and HMO products have seen rate reductions of up to 0.25%. And Halifax, well, they've done a little bit of both as well. Some rates up, some rates down. So moving on to affordability changes. This week, we've seen Santander increasing their income multiple limits, meaning that you might be able to borrow more. West Brom have done similar, and they're now offering up to 5.7 times your income if you earn over £75,000 and your mortgage is up to 90% loan to value. Halifax have upped their maximum too. It's now 5.5 times for first-time buyers with a household income above 50,000 and again a loan to value up to 90%. But Nationwide, well, they're a little bit different. They've improved affordability for remortgage customers, which is great news, because most recent changes from the majority of lenders have all been focused on first-time buyers and home movers. So for those people that need to remortgage, this is a big deal. We all know that when it comes to the end of your fixed rate, sticking with your existing lender isn't necessarily the best thing to do. They don't always offer the best rates to their existing customers. Seems like loyalty is dead. Now, don't get me wrong, there are a couple of lenders that will look after existing customers, but on the whole, most of them don't. And that's where these affordability changes from Nationwide really come into their own. Being in a higher interest rate environment, affordability is getting stretched to the limit, and some customers are finding it difficult to remortgage away from their existing lender over to a new lender. So for Nationwide, to increase income multiples for people that are remortgaging, especially on a like-for-like basis where they're not borrowing any more money, it's a great move. And I do hope that we see it from more lenders. Now, for the observant of you, you will have noticed that there wasn't a video last week, and my apologies, I had a week off and I just didn't have the facilities with me to be able to record a video. Of course, that happened in the week when the Bank of England, as expected, reduced the Bank of England base rate to 4%. Now, whilst it was expected, we did say in previous videos that it was a close call as to whether or not we would see a rate cut because of the state of the economy. And we were right. It was a very close call. With a vote of 5-4 in favour of cutting rates, it does beg the question, will we see any more rate cuts this year? There is expectation that there may be one, but of course there are no guarantees. In the notes that accompanied the decision from the Monetary Policy Committee, there was a lot of talk about the state of the economy. And it is, as we all know, looking extremely shaky, with inflationary pressures still hanging around in the background. In fact, swap rates, which have much more of an influence on mortgage pricing than the Bank of England base rate, well, they've gone up since the announcement. And that means that some lenders could increase rates the coming weeks. I have been warning about this for several weeks now, yet the day after the base rate cut, my inbox and my text messages exploded with customers asking, Craig, will we see mortgage rates drop, or have they dropped mortgage rates following the Bank of England base rate decision? Well, the answer was quite simple. No, they haven't. Yes, on the rare occasion, lenders do look at what the Bank of England base rate is doing, but they're more interested in swap rates. Swap rates are what directly affect mortgage pricing. So don't assume that just because the Bank of England reduced rates, that mortgage rates are going to follow. Of course, if you're on a tracker mortgage that is tracking the Bank of England base rate, yes, your rate will be directly affected. But for everybody else on fixed rates and other mortgage products, no, you're not. Now, I have put a swap rate chart up on screen, and you can see, if you look at the most recent column, that actually swap rates are higher than they were about a month ago. And that just goes to show that just because the Bank of England reduced rates, it doesn't mean that the market's going to follow suit, and then that mortgage lenders are going to follow suit too. So what does all of this mean? Well, if you're about to remortgage or buy a property, the window for lower mortgage rates might be getting a little bit narrower. The affordability improvements that we're seeing, well, they're great. But if swap rates do keep creeping up, we could soon start to see mortgage pricing reverse and going in an upward direction. That said, we are still in a better position than we were 6 months ago, and competition between lenders is keeping rates competitive. But it's important to note that lenders do fluctuate rates anyway throughout the year, regardless of any other movements with swap rate, and that's to manage a couple of things: their workflow and their loan book. If a lender is extremely busy and customer service is starting to take a hit because they're offering the lowest 5-year fixed rate, for example, they might increase that 5-year fixed rate so that they push some business to other lenders. Likewise, if they find that they've been lending too much at 95% loan to value and they need to balance their mortgage book a little bit, they might increase their 95% loan to value rates. Again, pushing the business away from them onto another lender. So rates do fluctuate with lenders regardless. But yes, swap rates are the thing that will directly affect the mortgage pricing. For landlords, there have been some small but meaningful cuts on buy-to-let products, especially in the limited company space. But the real gain this week has been on those mortgage affordability improvements. So if you are looking for a mortgage right now, well, my advice is simple. Don't wait for a huge drop in rates, because you might get caught out. Get your options reviewed now, and if the right deal is there for you, just push ahead. Now, if you have enjoyed this video and you've found it useful, please do give it a like, and why not consider subscribing while you're here so that you don't miss next week's update. I do see the statistics, and there are an awful lot of people watch the videos that aren't subscribed, so if you're one of them, please do consider giving us a subscribe. There's a lot changing in the mortgage market every single week, and I'm here to make sense of it for you. I'll see you next time. Take care.